Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, I'd like to talk about the equity markets, and it looks like now like the equity markets are either scaring everyone or wearing everyone out, but we actually might be near a near-term bottom, and those are the things I'd like to talk about. So first off, the markets, they've been volatile, they've been choppy, but we continue to see support. For instance, on NASDAQ, right about that $7,500 level. It tested its 50-day moving average, which is a little bit above that $7,400 level, though it's an obvious support level, but yet it's holding it. Similarly, in the S&P 500, continues to hold that 2,700 level, and again, that's correlated to its 50-day moving average. Now, in the Dow Jones Industrials, they're kind of staggering below its 200-day average, holding on to a little bit below it, but still above that 24,000 level. So as long as these levels are holding now, the market had plenty of opportunities to implode below these lately, and they haven't. So that tells us that the market may indeed have found support. But more importantly, why I think the market's wearing people out or scaring them out is we look at some of the contrarian indicators, some of those, for instance, sentiment surveys. If we look at the AAII, that's the American Association of Individual Investors, they do a sentiment survey every week, and we saw that the bullishness dropped about 10 points from 38% to 28%. And 38 is about kind of a historical average, so that tells you that people are not as bullish. Similarly, their bearish sentiment jumped 10 points to about 40%, and typically, historically, that's around 30%, so that tells us that people are getting scared. Now also last Thursday, we saw the put-to-call ratio close above 1.32, and that tells you that people are getting scared, so they're buying more puts than calls, sort of a defensive thing. And also on Friday, we saw the put-to-call close at about 1.24. So that again tells you that people are getting nervous. Now here's the big thing. Last week, we saw 20 billion of outflows out of equity, mutual funds, and ETFs. That's the biggest outflow since the first week in February. And that first week in February actually marked the low of the market, meaning people are just pulling money out of the market. They're so scared. In fact, the peak inflows peaked right about the January peak, and they've been negative since. So it just tells you again that the market is wearing people out. If it didn't scare them out, it's wearing them out. So people are just kind of focused on the headline news and getting very nervous. Now, as always, I say that price and volume be your guide. And for now, the action is telling us that the market may have found support at these support levels. Of course, we'll rewrite that theme if we see the NASDAQ start crashing below the 7,400 level, S&P consistently below 2,700, or the Dow below 24,000. So keep your eye on the sentiment indicators, keep an eye on price and volume, what it's telling you. Look at growth stocks that are performing, namely our bellwether stocks. We look at stocks like Netflix and Amazon. They're kind of hanging in there, not moving forward, but not falling apart either. So that tells us something about the market. So, as always, that price and volume be your guide. This is George Kachuk for RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. And have a great trading week.